completion and review. Okay, completion and review. Completion, automatically we are at the stage where we are talking in terms of what are the things we are doing. We are talking about the subsequent events and going concern. Little bit more challenging here. Okay, completion and final review. Okay, more challenging, is it? Now what we are doing, we have to make sure that subsequent events, before reporting date, after reporting date. What is the IS standard? I think IS 10 is there, if I remember, is that IS 10 talks about the events after the reporting date. Okay, we will cover this. Okay, you have evaluation of misstatements, very important going concern. Is that we have to make sure that this has been done. What are the in order to support completion and review, we will have analytical procedures, review procedures, and written representation. These are the supporting things. Okay, this will support. Is it? This will, all three will support. In order to, I will write here. Okay, I will write here. That makes things. Okay, all this will, what we will do. This will support. Okay, this will support the review, completion and review process to think about subsequent events, material misstatements, and going concern. Okay, what the examination says, one of the questions in the examination, they made it very clear. You will be focused on completion, review, and reporting. Recent results may result in adjustment to the events may result in adjustment to the financial statement or need to be disclosed or need for a disclosure note to be added. The auditor will also evaluate the effect of any uncorrected misstatements, as this may lead to a modified. Any uncorrected will have a modified opinion. In the exam, you may have to evaluate the misstatements and suggest additional audit procedures to be performed to reach a conclusion on such matters before stating the impact on the report to be issued, if the issues are not resolved. 1 second. Is that what you have to do in examination? This is very important. The auditor will also evaluate the effect of uncorrected misstatements, as this may lead to modified audit opinion. Okay, change the color, that only it makes sense. In the process, in the exam, you may have to evaluate misstatements and, okay, another thing is that, and suggest additional procedures to be performed to reach a conclusion on such matters. To reach a conclusion on such matters before stating the impact to the report if issues are not resolved. Very clearly, mechanically, that's what it's a procedures means. It's a very, very specific what we have to do. First thing, you have to evaluate the effect of uncorrected statements. You have to evaluate once you evaluate the misstatements, you have to suggest the additional procedures. And you have to make to reach a conclusion. To reach a conclusion that yes, it is going to affect or it is not going to have effect. Then subsequently, if it is corrected, if it is not corrected. If it is corrected, resolved, fine, nothing will happen. Resolved, fine, just you will make a note. If it is not resolved, then you have to disclose it and you have to give a modified opinion. Are you clear about this? Every chapter, whenever you are covering this, little bit you have to be very, very professional, okay? Exam focus. It makes things very, very clear where we have to do, where not. Now, This is where the subsequent events are there. Events after the reporting date. Okay, subsequent. Whether an event occurring between the date of financial statement and date of the auditor report. Is it between that date? Is it that you will have the 31st December? Okay, 31st December. What? See, if you take in our case, this is where it says is that the last date of submission is on 30th April. Now people will submit, okay, as much as we are doing the work, you will submit any time. Okay, assume you are making a point on 31st March. Okay, your auditor will audit report will become on 31st March. And facts that become known to order after the date of auditor's report. Is it? Now, it says some things, is that very interesting? Some things you will come across before signing, okay? Something you will come across after signing. Okay, something you will come across after signing, but before 30th April. Is that this is the most critical. It is going to impact the financial statements or it is not going to impact the financial statement. That's the only simple concept. Okay, that is the only simple. What is a IS 560? Is that IS 560? Subsequent events. Okay, what it says, read the things very clearly. Obtain sufficient appropriate audio about whether the events occurring between the date of financial statement and date of audit report, which if it require adjustments or disclosures are appropriately reflected in accordance with the reporting framework. If there are any events, okay, if there are any events happen, which is very simple, from the date of financial statement to the date of auditor's report, okay, to the date of auditor's report. Is that audit? This is you can put it very specifically. This you put it as a financial statements. This you put it as a auditor's report. Now, that is the first thing. The means it requires the auditor to obtain any you have to anything happen after 31st December, you have to get an sufficient appropriate evidence. And if it is adjustment is there, disclosure is there, we have to do. Respond appropriately the fact that become known to the auditor after the auditor's report. Is that anything happens after the auditor reports, okay, after the auditor's report, before it has been issued, okay, because before it has been issued, is that we have to also be very specific. IS 10 events after, yes, IS 10 events after the reporting period. Two types are there. We have done this. One is adjusting, one is non-adjusting. Is it? One is adjusting, one is non-adjusting. Read this one.
Yes, sir.
Is that simple one? Okay, simple one. Okay, any tax liability, any errors of fraud, any claims are there. Okay, voting claims, any sale in price, non-adjusting events. Okay, the events. What are the non-adjusting? See, only identification is this one. Either you take at any level. Okay, there are events, conditions whose arose after the reporting date. Definitely, if it is there after 31st December, it will come in this year. Why it will we are taking it to the back year? Okay, why we are taking to the in order to prevent financial statement presenting a misleading information. Disclosure is required. That is the if you this is the basics. You in our first accounting class we have what we have taken we have taken the concept of a matching principle. Okay, matching the periodicity concept, matching principle. Okay, is that we are matching in terms of dates also. We are going to be very specific in order to prevent from presenting a misleading. Disclosure is required in the notes financials indicating that what effect the events may have. Such event therefore will not have any effect on the for the period. It happens in the next period, not for the past year. Is that not for the, I will not say past year, it has not happened in the current year, it will happen in the next year. Issue of new share capital or loan. Is that we are issuing, we are not issuing. Major changes in the composition of, for example, see, if you remember, where we have done, they have made an announcement. Is that they have made an announcement? Is it right? It is a which word we have used there? It is a management commitment. Is it? It's a management commitment. Okay, the announcement, if it is there, announced, but you are announcing the dividends after the reporting date. After the reporting date, you are having any issue of new capital. Okay, loss of non-current assets or inventory in result after 31st December it happens. We will not take this year. We will take next year. Any strikes, government action. Is there any purchase sales of significant non-current assets? After 31st December, we will not, but it has been given very clearly, somewhere in between the lines. Is it right? Somewhere in between the lines. Is it right? What they say? In order to prevent financial statement from presenting misleading is a disclosure is required in the notes to the account financial statements. Is that disclosures is required? Okay, adjustments are not. If there is no adjustment, there should be a disclosure. Is that if there is no adjustment, there is a disclosure. Now, what it says, year end date, or see, this is the active and this is the passive. Again, for the first time, we are covering this. Okay, is that what? Perform procedures to ensure year end date have been accounted appropriately. Once financial statements are issued, auditors signed, financial statements has been issued. No obligation to perform, but must take action if they are aware of the events which will cause modified opinion. Very, very important diagram to understand. Okay, if it is once financial statements has been issued, is that now you have the year end date, you have the auditor will sign, and you have issued. It is nothing but the shareholders meeting. No obligation to once it has done, but must take action. Okay, but if they become aware of events which would cause a modified opinion. Very, very thin area of judgment and very, very critical. It's a very critical. Our judgment should be based on the timeline. Okay, our judgment should be based on whether we have to make, if it is financial statements are issued, then it will be a passive duty. Okay, are you clear about this?
Yes, sir.
Okay. Fine, this is okay. It is normal process. Okay, between the date of financial and date of auditor's report, the auditor should perform procedures, is it, to identify. We don't have any other that might require adjustment or disclosure. If material adjusting events are not adjusted, or material non-adjusting events are not disclosed, the auditor will see. If material adjusting events are not adjusted or material non-adjusting events are not disclosed, neither it is adjusted nor it is disclosed, the auditor will ask management to make necessary amendments. If the identified adjustments or disclosures necessary are not made, the auditor considers the impact on the audit reports and modification of the opinion is necessary. He will perform the procedures. If they have not adjusted, not disclosed, they will ask the management to make necessary procedures. If the adjustments of disclosure, if the identified adjustments are not made, then the auditor will first they will perform the procedures. Then they will ask the management to make the corrections. If they have not done, they will mention in the auditor report modified report. Okay, modified report. Simple process, is it right? Subsequent event. Inquire the management if they are aware of the event, adjusting or non-adjusting, which has not yet been included or disclosed. First, you have to inquire whether it is adjusting or not. Inquire into management, the procedures and systems for the what is the procedures, what is the rules of the events after the reporting period. Reading the minutes of the board. Anything has been mentioned. Review accounting records, budgets, forecast, cash flows, and other interim information. First, you have to inquire with the management, which has not been included, which not had been disclosed. Then you inquire the manager what are the procedures. Maybe there will be some different procedures, that's why they have not included. And review the meetings and review accounting records, okay, to have a clear understanding. Now, this is the additional one. What we have to do, obtaining a written representation from the management that they have informed the auditor all events and accounted them appropriately. Is it? We have to get the writing. Inspection of correspondence with the legal advisors. Review the progress of risk areas and contingencies. Consider relevant information which comes to the auditor attention from sources outside the entity in terms of public knowledge, competitors or suppliers. Inspect the after date receipts. Inspect the bank account, ledger account, is it, after the year end. That's very important, okay, after the year end, for payment that was not accrued, at the year end. Any payments we have, any receipts we have received of payments or receipts we have done after the year end. Inspecting the sales price of inventories after the year end. This will really take things very, very specifically. See, receivables, cash and inventory. Is it okay? Read once very quickly. From subsequent events, all the points, slowly.
Yes, sir.
Okay. Most critical one, they will judge. Okay, they will have a very clear, one question will be there, means definitely we have to be between the date of audit report and financial statement issued, and after the financial statements issued. Is that this is the thing? What are the four? They are giving you the date, day between the date of financial statements and date of audit report. First one, subsequent events. Okay, procedures. Now another. This is the second part. Okay, this is the second part. From the date of audit report to the issue, the auditor had no obligation to perform audit procedures after the audit report has been issued. Done. Is it? However, if they become aware of the fact which has caused them to amend the auditor's report, they must take action. Very, very sensitive. Okay, very sensitive. And you will not come across, very, very rare, one in a, I can say, it's a very rare that once it has been issued, again you are changing the audit report. It will have a reputation risk on the firms. This will normally be in the form of asking the client to amend the financial statements, auditing the amendments and reissuing the audit report. If management does not amend financial statements and the auditors not yet issued to the client, the auditor can still modify the opinion. Okay, that's what happened. If the audit report has been provided to the client, the auditor shall notify. If the auditor reports has been provided to the client, the auditor shall notify management and those charged not to issue before the amendments are made. Okay, this is the most challenging. From January to April, the most challenging months is that if before the auditor the audit, before you complete the audit, if the client issue financial statement despite being requested not to issue by the auditor, they can take the action to prevent reliance on the report. Okay, first see, auditor has no obligation. The first point. Okay, the first point is no obligation. Is it? The second point is if there is exceptional, we have to take. The second point is what? They will normally be in the form of asking. They will ask the client to amend. If management will not amend, then their financial statements report has not, and the auditors has not yet been issued, the auditors can modify. Now, fourth point, if the auditor report has been provided to the client, the auditor should notify. Means it has provided, not issued. It has been provided. Then what the auditors will say, not to issue the financial statement. After making amendments, you have to issue. If the client issues the financial statement despite not to issue, the auditors will prevent reliance on that. If once it is issued, legal advice should be sought. In this situation, courts have to prevent reliance on the audit report. Depends on the auditor's legal rights and obligations. Very simple. Okay, very simple. There is no obligation. If the things are serious, you can take action. Is that first you ask your client to make changes. Second, if client management does not make the changes, you can modify the report. If the auditor is given the report to the client, ask them not to issue the report. If they have issued the report, then the trigger will get activated. The trigger will get activated and the auditor will take action. And not only they will take action, but also they take a legal advice. Okay, understanding with the concept. Don't memorize it at all. You take pen and paper and just put pencil and paper and you put like this. What has to be done in the first phase? What has to be done in the second phase? Is that if there is anything no like this, the most easiest way of understanding is prepare a flow chart. Okay, how the things are flowing from one stage to another stage and what is the last action you are taking. Automatically this makes real clarity in your understanding. After the financial statement issued, the auditor has no obligation to perform audit procedures. However, if they became aware of the fact, they would have caused them to amend the report. They must take action. If they have been issued, there is no obligation, but they will have to take action. Okay, the auditor should discuss with the management and consider financial statements require amendment. Is it? The auditor should perform again procedures on the amendments. They have ensure that they have put them correctly. First you have to counsel them. That's simple one. Get the procedure. First you have to tell them that you have to do. Once they have done, fine. It's okay. That's not a big thing. But if they resist, then the problem will solve. The auditor should review the steps taken by the management, to ensure anyone who is in receipt of the previously issued financial statement. To ensure that who have been received the financial, the auditor should issue a new audit report, including what we have to mention, emphasis on matter or other matter paragraph. To draw the attention, emphasis of matter is an exclusivity clause in the audit report. You are mentioning something very emphasis. We are giving some extra attention to draw attention to the fact that financial statements and audit report has been reissued. If the management refuse to recall and amend the financial statement, they will prevent reliance on the audit report.